To keep yourself updated, subscribe to Indigo Learn and click the bell icon and download our app OneFin to start learning on the go.
Welcome everybody, and let's start off. I'll be sharing my screen. So as far as accounting standards are concerned, right, we have accounting standard 4, accounting standard 5, you have 7, right, then you have accounting standard 9. A lot more theory involved, very few questions can be tested on practical or numerical basis. A lot of these standards have theory, right? As you move towards the other part, like AS 19, AS 17, where or earnings per share, deferred taxation, there some numericals can be tested, but largely these standards have lots and lots of theories. So starting off with accounting standard 4. Now the crux of the standard for your exam purpose, and please note this is a revision lecture, this is not a full-fledged lecture. Accounting standard 4 deals with contingencies and events occurring after the balance sheet date. Okay. Now as far as contingencies are concerned, accounting standard 29 deals with contingent liability. So a lot of things which were earlier dealt by AS4 are now covered under AS29, provisions and contingent liabilities. What is covered in AS4 as a part of contingency is only contingent losses, like provision for bad debts. So provision for bad debts arises out of a contingency. Such things are covered here. And we obviously have coverage of events occurring after the balance sheet date, right? Now, what are contingencies? Contingencies are uncertain events, right? Now, the event may happen, the event may not happen. Based on that, we may have a loss, we may have a gain. Both the scenarios are possible. So, say for example, there is a debtor, and the debtor owes us some money, and there is a the debtor is not doing good, he is in financial crunch. So, there is a contingency that the debtor will not pay us the amount. And when there is this kind of contingency, there may be a contingent loss, because of which we create something called as provision for bad debt, right? Now, don't get confused. This provision is not provision as per AS 29. This is just an allowance for bad debt. That is as far as contingency is concerned. Don't need to break your head more than that in this case. The other aspect is events occurring after the balance sheet date. So what is this event occurring after balance sheet date? Let me open one Excel. So this is something which I wanted to share with you quickly. I could not, the audio disturbances and all of those things. This is one thing where we can see the weightage of marks, and we have only considered after July 21 because AS4, AS5, AS22, AS17, these were moved from group 1 to group 2, and now you can see every attempt 30 marks of questions are being tested from accounting standards. This is what you can secure if you are fully confident with accounting standards. Compulsory question 20 marks and at least 2 to 3 questions in the last question, that is question number 6. Okay. Now coming to contingencies and events occurring after the balance sheet date. What are these events occurring after the balance sheet date? So there is a balance sheet date. In our case, mostly it will be 31st of March, let us say 21. Any event occurring after this date, 1st April onwards, till the time the financial statements have been approved by the approving authorities, what all events happen? Those are events occurring after balance sheet date. So let us say board of directors, they approved on 15th of April, maybe slightly early, maybe let us say 31st of May. Okay. Now events occurring between 31st of March, that is on 1st of April, on or after 1st of April till 31st of May, what all events are occurring, those events are called subsequent events. Those events are called subsequent events. Now, as far as your standard on auditing is concerned, there you have to consider till audit report. But here, only till the time they have been approved by the approving authority, mostly board of directors in case of companies. Okay. Now, so these are the events that occur between the balance sheet date and the date on which the financial statements are approved by the approving authority, board of directors or approving authority. Very important for you to remember this definition, this specific definition, because whenever a question is tested from accounting standard 4, you are expected to write this particular definition. Okay. Now, all of you might be aware that, or all of you would have learned that all the events which occur after the balance sheet date can be categorized into 2 parts: adjusting, non-adjusting. and you would have learned sufficient examples. But what happens is in examination, sometimes you tend to get confused, and most of the students, they do not write the definition and they do not tell what is to be done if it is an adjusting event, what is to be done if it is a non-adjusting event, right? So again, when you're writing the paper, define what is a subsequent event, explain adjusting and non-adjusting, and then give your conclusion accordingly, because here you will get mostly a theory question. Even if it is a numerical question, that will be revolving around theory only, right? Now, adjusting event, the name itself suggests these have to be adjusted in this particular balance sheet or financial statements. So when I say adjusting event, these events are adjusted. These events are adjusted in the balance sheet. Non-adjusting events, they are not adjusted. They are not adjusted. What do we do in that case? These are disclosed in report of approving authority. Okay, so maybe in the board of directors report you can disclose this non-adjusting events. Then there is one more category of event where there can be a question on the going concern assumption of the entity. Say for example, the entity had a plant that was the only plant, the largest plant for the company, and that plant got damaged in fire, because of which the existence of the company comes under question. The company may or may not exist in the future, or the company may not be able to operate in the future in the manner it intends to. So whenever there is a question mark on the going concern assumption, then though it may be a non-adjusting event, generally that has to be considered as an adjusting event, and you will have to restate your financial statements. You will have to prepare the financial statements as if the going concern assumption is not being followed, right? So that is the other aspect to this. Now, when do we say that an event is an adjusting event or a non-adjusting event? The key term here is additional evidence for events existing on the balance sheet. Now, what do I mean by that? There is something which is existing on the balance sheet date, and now you are getting an additional information or additional evidence for that. The favorite question from by ICI in these cases is, there is a debtor, the debtor has become, there was doubtfulness that the debtor will pay back the money, and finally before the financial statements were issued, they realized that the debtor has become bad or the debtor has gone insolvent, amount will not be realized. What should be done? So all of us know there has to be an addition, and see, these are the key terms: additional evidence for events existing on the balance sheet date or the items existing in the balance sheet date, whichever you put it. So items existing on the balance sheet date, whenever you have additional information on that, those will be considered as adjusting event. Otherwise they will be considered as non-adjusting event. Exception here is if the going concern assumption itself is invalidated, then you will treat them as adjusting events. Are we clear? Now, what are non-adjusting events? Fire occurred in the factory, small fire occurred in the factory, or some fire occurred in the factory, some 10%, 20% loss. Those are non-adjusting events. But do we need to disclose them? Yes, they have to be disclosed in the board report or the report of approving authority. This is the crux of adjusting, non-adjusting event as per this standard. Now, do we report all the non-adjusting events? See, after the balance sheet date, till the time the board of directors approve the financial statements, there will be lots and lots of events. Do we disclose all the events? You will only disclose material events which require attention of the users of the financial statements, right? So adjusting events, you will adjust the asset and liability. Other events, you just show this, which just needs a disclosure, which are not an adjusting event. These are non-adjusting events. So key terms: balance sheet events providing additional evidence in support of conditions already existing on the balance sheet date. Okay, so this is a favorite question, as I told you, which you get in the thing. Then if the enterprise may cease to be a going concern, then you will have to consider that the going concern assumption is no longer valid. You may have to prepare a financial statement afresh. Okay, then the thing on proposed dividend, very important for you guys to understand. Earlier they had to be provided for. Now you just disclose them. Proposed dividends are just disclosed as required by the statute. Okay, so this is one thing that you can keep in mind, that if there is a proposed dividend, that has to be disclosed. And where do you disclose? Disclose in the report of approving authority, not notes to account. Don't write notes to account. It is in the report of approving authority. Okay. And for material events, what are you disclosing? The nature and estimate of financial effect, or if it cannot be estimated, the fact that it cannot be estimated, that has to be disclosed. Right? So this covers AS4. Let me see if we have any questions from the students. Yeah, you can get our notes from the free resources. Conditions must be existing on the balance sheet. So that is why if there is a fire which happens, then it is a non-adjusting event. If inventory, the value of inventory is reduced after the balance sheet date, you will not consider it to be an adjusting event, because you will take the valuation of inventory as on the financial year end, right? As on 31st March is the valuation of inventory. Subsequent reduction in value of inventory is not an adjusting event. Okay. Debtor is a monetary asset where you may not realize the amount, then that definitely is an adjusting event. Okay, so these are some of the theory questions. You can get it from our notes and revise them. I'll not go through them because all of them are around those critical definitions that we have said. But AS4 specifically, why I'm again and again emphasizing is definition is very, very important. Please write the definition. Please explain why it is adjusting or non-adjusting and give your conclusion. Then you can get your 4 marks or 5 marks of the question. Then accounting standard 5, again simpler concepts. Around those concepts only you will get the questions in the examination. That is your net profit or loss for the period, where we talk about the ordinary items and extraordinary items, then prior period items and changes in accounting policies. These are the 3 aspects which are broadly covered by accounting standard 5. So what are ordinary activities? Ordinary means your day-to-day activities. These are the activities which are undertaken by an enterprise as a part of its business, and such related activities in which the enterprise engages in furtherance incidental to or arising from these activities. Basically, these are the basic day-to-day operating activities of the entity. These are the activities which the enterprise carries out on a regular basis. This is the you can say the bread and butter activities of the enterprise. These are ordinary activities. Okay. Then what are extraordinary activities? Extraordinary items, there is nothing called extraordinary activities. Extraordinary items are those items which arise other than from ordinary activities of the enterprise, and they are not expected to occur regularly. So these are not from the ordinary activities. These are not from the ordinary activities, and they are not expected to occur regularly. That is when we call these items as extraordinary items. Sometimes extraordinary items are called so because some other standard says that that particular transaction is always treated as an extraordinary item. For example, refund of government grant. Refund of government grant is always an extraordinary item. It may be a small refund, but as per accounting standard 12, refund of government grant is an extraordinary item. So ordinary, your day-to-day activities, your day-to-day operations, buying of goods, selling of goods, manufacturing, customer collection, customer repayment, all of these are ordinary activities. Say for example, one fine day because of fire, there is a huge loss in the factory. Okay, within the balance sheet date, it's not a event occurring after, but within the balance sheet period itself, there is a loss due to fire. Then what would you think? Is it ordinary or extraordinary? That is definitely an extraordinary item because you don't expect it to happen regularly. Similarly, gain on you dispose of fixed assets, those are not expected to happen regularly, and hence they are treated as extraordinary items and disclosed separately. See, the aspect around ordinary and extraordinary is only with respect to disclosure. Extraordinary items have to be disclosed separately on the face of the financial statements, right? Ordinary activities are also disclosed, but they may be clubbed together. But extraordinary items, we have to disclose them separately on the face of the financial statements, right? This is about ordinary and extraordinary. Sometimes what may happen is an ordinary item may be of such a nature that it requires separate disclosure. So it may be an ordinary activity, but it may require a separate disclosure because of the nature or size of that particular item. In that case, you will make a separate disclosure of the ordinary items as well, right? So this is briefly with respect to ordinary and extraordinary. A lot of emphasis in AS5 is given on prior period items and accounting policies. Now, for prior period items, what you need to understand is these are incomes or expenses. These are incomes or expenses which arise in the current period as a result of errors or omissions in the preparation of the financial statements of one or more prior periods. So, let us say you are in the current period 2020, 21, 22, for example. Okay, there is some item which has come into this period, an item of income or expense. Why did it come? Because there was an error or omission in one or more prior period. Meaning to say, let us say in 2020, depreciation was incorrectly computed. Now, if it was incorrectly computed, what would you do? You will give that, you will correct the depreciation impact and you will show it separately in the current period financial statement as a prior period item or prior period expense. Meaning to say, there was an error in the previous period. There was an error in the previous period, and because of that error, we are now correcting that depreciation impact in the current financial statement. Current financial statement carries that additional depreciation. That is because of a prior period item. That's what it is called, a prior period item or prior period expenses. Okay. Then why should it come? Because of an error or omission. You forgot to charge depreciation. You forgot to charge depreciation in one of those assets. You have omitted, or there is an error which you have committed. Maybe some Excel formula error by while copying from top row to the bottom row. You have missed that formula. You have done a cut instead of doing a copy. Anything can happen, but there was an error. So I have seen some errors like the carrying amount of assets have become negative because depreciation was continued to be charged even when the residual value was even when the carrying amount of that asset had become zero. Because Excel, right, thousands of assets, you simply do a copy paste, there can be an error. If it is an error, then in the next period you will have to disclose it as a prior period expense. That is one thing you need to keep in mind. Now, say for example, for the same asset, the estimated useful life was considered to be 5 years, and now in this period we have reassessed it as 6 years. Is it an error? No, it is not an error. Is it an omission? No, it is not an omission. It is a change in accounting estimate. So you have to distinguish between errors, omissions, and changes in accounting estimates. If it is a change in accounting estimate, it is not considered to be a prior period item. Or if it is a change in accounting policy, even then that is not considered as a prior period item. You change your accounting policy, valuing of inventory from FIFO to weighted average. Is it an error? No. Is it an omission? No. Is it a change in estimate? No. It is a change in accounting policy. So changes in accounting policies are also not prior period items. Now these are the areas which are tested in the examination. They will give you a scenario and say, is this a prior period item? Or is this a change in accounting policy? You have to understand that carefully and give your answers accordingly. Then what are accounting policies? We have learned in AS1 also. Specific accounting principles applied in preparation and presentation of financial statements. Example could be your inventory, valuation methods. Depreciation methods and all of those, they are considered to be, whenever you do a change, as per accounting standard 10, they have been now considered to be a change in accounting estimate. That is because it has been brought in line with Ind AS 16. That is the reason why now, earlier it was a change in accounting policy. Now it is a change in accounting estimate. Okay. So what all we discussed so far? While preparing the financial statement, you will disclose ordinary activities, extraordinary activities separately, prior period items separately, accounting estimates separately, and changes in accounting policies separately. So a specific focus again on some exceptional items. Though certain items may not be extraordinary items, the nature and amount of such items may be relevant to the users of financial statements, understanding the financial position and performance of the enterprise, and hence they are disclosed separately. They are disclosed separately. You dispose of a division altogether, right? So that may be an extraordinary item. But you have sold a lot of, you have sold a fixed assets. Now these fixed assets, you will disclose them separately. Examples for ordinary activities which require separate disclosure. So these are some of the activities which may require a separate disclosure, though they are, ordinary activities. Okay. Please discuss one or two illustrations. Sure, I will include that. And we discussed extraordinary items are distinct from ordinary activities and therefore are not expected to reoccur frequently. And that is what it has to be disclosed separately. Now, see, some items may be extraordinary, some may be ordinary, some may be exceptional. You cannot have a hard and fast rule. Based on the circumstances of the case, based on the facts of the case, you have to take a decision, right? Yeah, so another thing you can keep in mind is if there are some arrears which are paid to the worker. So there were some settlements going on, and in this year you pay arrears of the past year. Those are not prior period items. Changes in accounting estimate is a normal state of things. So I'm just exclude that. Then changes in accounting policies. Another favorite question, which gets tested quite often. When can an entity change its accounting policy? So a change in accounting policy is permitted if it is necessary by provisions of statute, that is law, or for compliance with an accounting standard. So if there is an accounting standard which requires you to change the accounting policy, then you can change it. If a law requires you to change the accounting policy, then you can change it. Or if it results in a more appropriate presentation or a better presentation of the financial statement, then you can change the accounting policy. And whenever there is a change in accounting policy, you need to disclose the impact of the change. If the impact of the change is in current period, what is the impact of change? So an example could be, during the current period, the entity changed the method of valuation of inventory from FIFO method to weighted average method. Had the entity not changed its accounting policy, then inventory would have been overstated by so much, and P&L would have, the profit for the year would have been excess by so much. So you have to give a disclosure like this. What is the change in accounting policy? What is the impact of the change in accounting policy? Right. So both the things have to be disclosed. So any change that materially on the financial position has an impact, performance of the cash flow should be disclosed such that the adjustment resulting from such a change is clearly brought out, right? That is what is required to be changed. And what should be disclosed? You should disclose what is the impact of the change and to which periods will the impact of change apply to. For example, does it apply only in this period, or does it apply in this period and also in the future period? That has to be disclosed. So some quick explanations. Methods of depreciation, changes in estimated useful life, and all of that are accounted for as change in accounting estimate. Change in inventory valuation method is a change in accounting policy. Wrong calculation of depreciation, as we discussed, is a prior period item. Attachment of a property by a court or loss of an asset in a natural calamity is an extraordinary item. Wrong counting of a closing stock is a prior period item, because here there is an error. Changes in provision for doubtful debt is a change in accounting estimate, right? So this will help you to relate what is change in accounting policy, what is change in accounting estimate, what is a prior period item, what is an extraordinary item, and what are ordinary items. So based on the request from one of you, let me just take a couple of questions. So here there is one question. X Company Limited signed an agreement with its employees union for revision of wages in June of year 12. Okay. The wage revision is with retrospective effect from 2008. Revision was signed in 12 and it is having a retrospective effect. Arrear up to 31st March of 12 amounts to 80 lakhs. Arrear wages for the period 1/4/12 to 30th June amounts to 7 lakhs. Decide whether separate disclosure of arrear of wages is required. Now, what is this? This is a change in accounting estimate? No. Is this a change in accounting policy? No. there was some settlement which has happened with the employees. It's not also a prior period item. It's also not a prior period item, right? So in this case, what has happened? The arrears are finalized in June 12th. Arrears are finalized in June 12th. Okay. So it is not an error. It is not an omission, right? And wages that you pay to the employees, these are ordinary activities. But some ordinary activities may be of a significant, may have a significance, because of which you may require a separate disclosure. They may be exceptional items. You are paying 5 years of wages in a single year. In that case, definitely there is something which is significant. There is something which is material, and hence a separate disclosure may be required. And also note, whatever is the amount from 1st April to 30th of June, these are ordinary activities. These are the expenses pertaining to current period only. Okay. Yes, and other thing is, if you have made certain provision for expenses for some amount, let's say 7 lakhs here, but actual expenses are 9 lakhs, then whether the 2 lakh is a prior period item, then in such a case you have to define what is a prior period item, and you have to explain why this is not a prior period item and why this is a change in accounting estimate. And because it's a change in accounting estimate, it is an item of ordinary. It is item arising from ordinary activities. There is no separate disclosures which are required. Right? So I think, yeah, these are the kinds of questions you would get. And maybe towards the end of the session, we'll take up, once we finish the session, the next session, we'll definitely take up more questions. Difference between extraordinary and exceptional. Okay, so when we talk about extraordinary items, these are not arising from ordinary activities. Exceptional means ordinary activities which may have a material impact, which requires a separate disclosure, which is of such amount or which is of such nature that requires a separate disclosure. Like we talked about the wages arrears, right? Those are from ordinary activities, but they are of a nature which requires separate disclosures. These are called exceptional items, right? Now, as far as the other question that we discussed, the difference of 2 lakhs in estimate, if that is considered to be material and significant, then you may require to disclose it separately. But you can make an assumption either side and you can give the answer. Okay, any more questions? Let me just go through. Yeah, okay. So this is done. Now the next standard, accounting standard 7, construction contracts. One standard where students make a lot of computational or silly mistakes, I should say. Okay. So what happens is, in this standard specifically, there is a lot of technical jargon involved, but if you try to break it out, it is very simple. It is very simple. This standard revolves around your the matching concept and obviously prudence. If you apply these two principles to the standard without going into the technicalities of the standard, as a normal accounting professional also, you will be able to do the treatment as given by this standard. Okay. Just to give you a perspective, let us say, so A7 applies to construction contracts. Right? Now, say for example, you have taken up a contract, you are a builder and you have taken up a contract. There are 2 years, 2020 and 2021. Okay. Now, in 2020, you have taken up a contract and you are incurring certain costs. Let us say you are expecting that you will incur cost of 80 crores, and next period you have incurred a cost of, let us say, 75 crores, for example. Right? And by performing this contract, your revenue that you will get at the end of whatever is the time schedule and all of that, you may get in installments and all of that. 80 plus 75 is 155. Let us say 200 is the revenue. Now, if I ask you what is the total profit from this construction contract, total, not year wise, what is the total profit? Total profit is, you will say total cost is 80 plus 75, 155. Total revenue is 200. So profit is 200 minus 155. 45 is the profit. Correct? 45 is the profit. Now, 45 is the profit that all of us know. What is the challenge? How much should be allocated to 2020? How much should be allocated to 2021? That is the challenge. Or say, for example, by the end of year 20, you have incurred 80 lakhs and you expect that you will, incur 75 lakhs in the next period, and the revenue is only 150. There is a loss of 5. Right. Now here you will apply prudence. If the estimated result or outcome of the contract is a loss, you will recognize that loss immediately. That is the first thing. In the earlier case, you will see how much is the cost incurred in 2020 as compared to the total cost. So you will say what is the percentage completion. Okay, percentage completion is 80 divided by 155. That comes to 51.6%. Let me just change it to percentage. 52. I'll increase the size. Just a second. Yeah, 51.61, and 75 divided by 155 is 48.39%. Now, the standard requires, the underlying principle of the standard under matching concept is the revenue should be matched with the cost. So if you have incurred cost of 80, which represents 51.61%, your revenue in this period should be 200 total expected revenue multiplied by percentage completion, that is 103.22, and in the next period it should be 48.39% multiplied by 200, which is 96.77. This is the overall crux of the standard. I'll come to amount due from customers, amount paid to customers, work certified, work not certified. We'll take one example on that, but this is the crux of the standard. Now, revenue minus cost is your profit. 23.23 is the profit here, 21.77 is the profit here. This is how it has to be recognized. If there is any loss which is estimated, that has to be recognized immediately. You will not apply proportion in that case. Otherwise, you will use percentage completion method to apportion the cost between each year of the particular contract, right? But obviously you have to ensure that the outcome of the contract should be certain. It should not be that you have not yet started the contract itself, simply you are just booking the expenses. That those things are not allowed. You have to check whether there is collectibility collectibility criteria. When we go to AS9, you'll understand that whether the customer will pay the amount to you, whether you can measure the cost reliability. That is also very important. Just that there is a cost being incurred, but if you are not able to measure the cost of the contract, it will be difficult for you to apply the principles of percentage completion. But as far as the understanding is concerned, this is the underlying principle governing this particular standard. And if you see, most of the questions in the examinations from AS7 is with reference to some cost incurred, some work certified, some work not certified, and then some amount received. What is the percentage completion? What is the P&L amount? And those related aspects, right? So what I will do is, for A7 specifically, I'll take up one problem and maybe one examination problem, 2 problems, to help you not masterfully, but you will be able to cover 80-85% of the standard once you understand those 2 things. Okay, so I'll not go into technical jargons here because there will be too much of things here. But yes, some specific aspects that I want to highlight here is, there could be a fixed price contract where there is a fixed price fixed in the contract, or there could be a cost plus contract where you have defined the cost, over and above the cost you will get some margin, right? So let us say 100 is the cost, 20% margin, 120 will be the revenue. So there could be a fixed price contract and there could be a cost plus contract. And what are included in construction contract? Your normal accounting principles, all the costs, direct material, direct labor, direct expenses, overhead for the particular construction activity, specific cost for the particular customer, all of those are included. Interest also, if permitted by AS16, are included, right? Then sometimes there may be a variation in the construction contract. Say for example, I wanted to construct a 2-floor building. Then I changed my mind and I said, okay, I don't want a 2-floor building. I want, let us say, 2.5-floor building. I want to add another half floor on the top of the second floor. Half floor means part of the building, right? Now, there is a variation. Now, because there is a variation, there may be an increase in contract revenue or there may be a reduction in contract revenue. But that is subject to the condition that we have to check the probability that the customer will approve the variation and the amount of revenue arising from the variation, and you can measure the revenue reliably. So just because I have changed, or the customer said I want the change and the construction contractor has changed it, but still you have to ensure that the customer will pay. There is a probability that the customer will pay, and you can measure the revenue reliably. And in such cases, you can add this to the contract revenue. Similarly, Sometimes you may have a claim, because of the steel prices going up, suddenly the contractor feels that the project is no longer viable. But now, because he has taken the contract, he has to execute it. He may go and negotiate with the customer, saying that, see, the steel prices are going up. Please give me that additional amount, because otherwise I'll not be able to work properly. All of those things. Contractor may negotiate. If the customer approves, very good enough, you can include that as a part of your revenue. Sometimes there may be incentive payments. Let us say I am a contractor. I got a contract to build a bridge, and the contract says if I build the bridge in 1 year's time, I'll get some amount as incentive. So I will get extra workforce and extra machineries and all of those things. I'll complete the bridge well in time, and I'll get the incentive. So again, for incentive, you have to see that whether the contract is in an advanced stage, that it will be able to meet the performance standard. So you can't say that today I'll start the contract, and today itself I've got extra workers and extra machinery, and today itself I want to recognize this incentive benefit. I cannot do that. It has to be in sufficient advanced stage. Let us say all the pillars have been poured, slabs have been poured, only small few parts are left over, which can be completed in the given 1 year period of time. In that case, I can recognize the incentive. Otherwise, I cannot recognize. And obviously, it has to be measured reliably. You will see in most of the standards, you must be able to measure the cost reliably or revenue reliably. You have to ensure the collectability. You have to ensure that the cost can be measured reliably. Even here, you will be able to measure the incentive reliably. Only then you can recognize the incentive payment. Less likely that you will be getting questions on these lines. You may get, I'm not saying no, but more often than not, you get questions on numericals. Okay, so let me just take one question quickly. This is a simple question, but still will cover most of the concepts that we are expected to learn in this particular standard. And then I'll take up one question from the exam paper, which will help you understand the linkages between various concepts given in this standard, right? Check anything. Okay. PRZ and Sons are heavy engineering contractors. Okay, fine. From the records of the company, the following data is available pertaining to the year ended 31st March of 17. And again, let me tell you, if you are able to understand this question, if you are able to solve this problem, most of the questions would be on similar lines, right? Using this data and applying relevant accounting standard, you are required to compute the amount of P&L for 31st of March, arrive at the contract work in progress at the end of financial year 16-17, determine the amount of revenue to be recognized out of the total contract value, work out the amount due to or due from the customers, and list down the relevant disclosures as per the relevant accounting standard. So what is there? There is total contract price. Total contract price is 2,400. This is the total revenue that the construction contractor will get over the life of the contract. Then work certified and work uncertified. 1250 and 250. What are these? These two are the cost incurred till date. Okay. Then estimated further cost to completion. Estimated cost to be incurred in the future is 1750. Now, if you see total estimated cost is 1750 plus 250, 2000 plus 1250, 3250. Then stage wise payments received. So payments received from customers. $1,100. Payments in progress. This also will be received. These payments will also be received. So customers has given, or we are about to receive, or we have received a check or something like that. Right now, correct. So this is it. Now, what are we asked in the question? We are asked to show Compute the amount of profit or loss for the year ended 31st of March of 17. Then what would that be? If you see here, total expected contract costs are 1250 plus 250 plus 1750. 3250 is the total cost. Total revenue expected is 2400. Now, the moment your contract cost exceed the revenue, then you have to recognize the loss. So 3250 minus 2400, this is the expected loss, right? That is the expected loss. Okay. Then it says arrive at the contract work in progress. Contract work in progress is your 1250 plus 250, 1500 is the contract work in progress. Correct. Then determine the amount of revenue to be recognized out of the total contract value. So what will be the revenue? Revenue to be recognized is based on percentage completion. Okay. What is the percentage completion? Total cost incurred is 1250 plus 250, 1500. And total expected cost is 3250. So 1500 is the numerator, 3250 is the denominator. If you do this, you get 1500 divided by 3250, 46.15%. 46.15%. This is the percentage completion. So revenue to be recognized will be 46.15% of 2400, which comes to 1107.69. Right? Then amount due to or due from the customers at the year end. Now this is one important formula where students get to forget. They tend to forget how to arrive at this formula. Very simple. There is a underlying logic behind this formula which you need to understand. What is the underlying logic? Say whenever you sell some goods to the customer, what happens? How much do you charge from the customer? You will say sale value is equal to cost plus profit. Correct? Simple. Sale value is the cost plus profit. If it is loss, sale value will be cost minus loss. Sale value will be cost plus profit or cost minus loss, whatever way you want to put it. Right? Now, if the customer has paid you, let us say, so cost plus profit, for example, cost is 100 plus profit is 20, 120, and customer has already paid you 80. This we call it as progress billing. Then how much is to be received from the customer? 120 minus 80, you have to receive 40 from the customer. Right? This is amount due from the customer. Very simple. The total cost plus profit minus loss minus any progress billing will give you amount due from the customer. But let us say the customer, instead of paying 80, has paid 140. Then you have received excess amount from the customer. Now this is amount payable to the customer. Now you may think, why will the customer pay extra? See, I'm not talking about sale of a single good. We are talking about a contract, construction contract, where the customer has paid us maybe advance amounts. The customer has paid us advance amounts and we are incurring the cost subsequently. That is possible, right? So if it is a negative number, then you will reduce, you will call it as payable. If it is a positive number, you will show it as receivable, right? So just to, this cost incurred plus profits minus progress payments received minus losses. So in our case, what is the cost incurred? What is the cost incurred? Cost incurred is 1500. Is there any profit? No profit. There is a loss minus loss of 850 minus progress billings of 1100 and 300. You get 750. So because it is negative number, this becomes amount payable. This is the simple underlying concept as far as accounting standard 7 is concerned. We have covered percentage completion. We have covered revenue recognition. We have arrived at the loss from the contract. and we have arrived at the amount payable from the, or amount payable to the customer, right? Just a second. Let me just open the question paper, one recent question paper. Yeah. So again, now the similar question. Now don't think that because it was tested in July, will it be again tested in November? It may be tested. We do not know. Okay. Following data is provided by a company. Contract price. This is the revenue. Material issued 21 lakhs, out of which material costing 4 lakhs are still lying unused. Meaning to say, you have given material or you have issued material of 21 lakhs, 4 lakhs is still unused, which means how much is the material used? The material used is 17 lakhs. Keep your head cool. If you keep your head cool, you'll be able to get this information easily. Then labor expenses for workers engaged at site, 16 lakhs, out of which 1 lakh is unpaid. We will follow accrual basis. So 16 lakhs will be the expenditure. Specific contract cost, 5 lakhs. So specific to the contract, there is a cost incurred of 5 lakhs. Subcontract cost for work executed, 7 lakhs. Now what does this mean? Sorry. Say you have taken a contract, you have given it to somebody on a subcontract basis. So the cost incurred there is 7 lakhs. And on top of it, there is advance which is paid to subcontractor 4 lakhs. Is advance relevant to us? No. We'll again follow the accrual basis of accounting, right? And further cost estimated to be incurred to complete the contract is 35 lakhs. You are required to compute percentage of completion. So we'll have to compute what is the total cost incurred. That is 21 minus 4, 17, 17 plus 16, 33, 33 plus 5, 38, 38 plus 7, 45, right? 45 is the contract cost incurred. 35 is the contract cost to be incurred. So 45 plus 35, total becomes 80, right? So 45 divided by 80, 56 is the percentage completion. Revenue to be recognized is 85 multiplied by 56%, 47 lakhs, and cost 45 lakhs. Very simple, right? Simple. Any questions on this? Okay. So no questions. So we can continue further. Just from the standard, understand how to compute the percentage completion, understand how to calculate the amount due from or due to customer. If there are any losses foreseeable, that will be recognized immediately, and what will be the amount of profit or loss will be dependent on how much is the revenue and cost recognized in the under the particular contract. And see, the only confusion point could be work certified, work uncertified, and all of those things. These are generally given to you at cost. They'll mention if they don't mention also, assume that those are at cost. Work certified means work completed, and maybe the customer has certified that okay, this work is completed, or some representative of the customer has satisfied. So that is one thing you can keep in mind. And work uncertified means you have spent the money, but the other party has not yet certified. That is what is work uncertified. So certified plus uncertified is the total cost that has been incurred, and to that add the future estimated cost. If that exceeds the revenue, then you will recognize a loss. Okay. Right. So now we'll move to the next standard, which is on revenue recognition. Revenue recognition, accounting standard 9. Very, very important. Not just only for the exam purpose, but also from practical standpoint of view. Now here also, the underlying principle of revenue recognition is what we must be clear about. What is revenue? Revenue is inflow of cash, receivables, or other consideration from critical things that are sale of goods, rendering of services, and from use of others by the resources and the resources yielding interest, royalties, and dividends. So these are all classified as revenue. So if you sell goods and if you get amount from the customers, that is defined as revenue. If you have provided services, you get some money from the customers, those are considered to be revenue. If the other enterprises are using, if you have, let us say you're a banking company, you have lent money, you get interest, that is revenue. If you have invested somewhere, you get dividends, that also is revenue, right? Now, once we have defined or understood revenue, we have to see when should we recognize revenue for different scenarios, and what all items should be excluded when we calculate revenue. So revenue means let's say there is a sale of fixed asset. There is a sale of fixed asset and there are some gain on sale of fixed asset. Is that a revenue? That is not revenue. That is not considered to be revenue. You increase the value of, not increase the value, you will, let's say you have reduced the value of inventory. Now, next period, the, NRV increases and now you have increased the value of inventory. Can that increase be considered as revenue? No, it cannot be considered. If you only sell those goods, if you provide them some services, the consideration that you get in return, that is what is considered as revenue. Okay. Now, revenue, you have to see first, whenever you have to recognize revenue, you have to see whether, let's say there is, sale of goods. Have the, in substance, the risk and rewards have been transferred to the buyer. Then you can recognize revenue from sale of goods. So basically, the property has transferred. Sometimes formalities are pending, but in essence, has the property been transferred? Then you will recognize the revenue from sale of goods. When it is from sale of services or provision of services, you will see whether whether the services have been completed. Based on that, you will recognize revenue. It can be on the basis of percentage completion method, or it can be on the basis of full service completion method. Either of those two things can be done, right? So, when we say revenue recognition, we mean you are accounting for those revenue in the books, right? Here you have to ask questions like, are you able to measure? Are you able to measure the revenue reliably? Now you may say, how do we know, or what can be situations where we are not able to measure the revenue reliably? Maybe those are dependent on some, cost plus some percentage of cost basis. You're providing services and they say, okay, whatever cost you incur, and we'll add some more percentage on that cost, and that becomes your revenue. And say, for example, you are not yet in a position to measure the cost reliably. Some small part of services have been given, then you may not be able to measure the revenue reliably. So you have to check whether you are able to measure the revenue. Then, will you be in a position to collect the revenue from the customer? You have sold the goods, but the moment, at the time of sale of goods itself, you had a doubt whether you'll get the money back or not. Now you may say, why will I sell to a customer if I don't get the money? Maybe possible that after, we have dispatched the goods, it was on pay on delivery basis. The customer did not want to pay. That could be one possibility. Or bank has given, let us say, loan to a customer, which is about to be default, which is in a, default mode, but still they have given some loans so that they may survive and they may be able to repay back. They have just taken some risk, and their collectibility may not be certain, right? So you have to check whether collectibility is certain or not. Or you have given loan for one period, you have got the interest, for the next period you have not got the interest. So there also again you need to check collectibility, right? So if you are able to measure revenue, you have to check that condition. Then you have to check whether you are able to collect the revenue. The probability of collection is also very, very important. Now, only when these two conditions are satisfied, you will be able to recognize revenue. You are able to recognize. But, okay, I'm not able to measure. You have to defer it to the time, till the time you will be able to measure. I'm not sure of the collectibility. Then when the collectibility becomes certain, or when the collectibility becomes probable, that is when you will recognize the revenue. Now, I've sold the goods. I have recognized the revenue, and after 1 month I realize that collectibility is not possible. Then what do? That point of time I create something called as provision for bad and doubtful debts. I will not reverse the revenue. So future collectibility issues will result in a provision. For losses. But at the time of the transaction, or in the process of the transaction, if collectibility becomes doubtful, then you will not recognize revenue. This will be deferred till the time collectibility becomes probable. Okay, so if these two conditions, measurability and collectibility, is satisfied, recognize, otherwise do not recognize. So as I said, if consideration is not measurable, then you will postpone recognition. If collectibility is uncertain, postpone recognition. Once you postpone, then in whichever financial year there comes the certainty, in that period you will recognize the revenue. And this we spoke about, you will make a provision if the answer later. Okay, now we'll come to specific aspects of sale of goods, services, and other aspects relating dividend, royalties, interest, and all those things. But for sale of goods, there has to be transfer of property. That is, the seller has either transferred the property, or all significant risk and rewards of ownership have been transferred to the buyer. For example, just for illustrative purpose, let us say you have purchased a two-wheeler. You have purchased a two-wheeler from the showroom. Registration is pending. Registration is pending, but two-wheeler, the showroom has sold the two-wheeler to you. Invoice has been generated. You have made the payment. Road tax is also paid. Registration is pending. Now, do you think the sale has happened? Yes, the sale has happened. The property has been transferred. Only a formality of registration is pending, right? So, because the formality of registration is pending, that does not mean that the property or the risk and rewards have not been transferred. So, once the risk and rewards have been transferred to the buyer, you will recognize the revenue. Okay, and the control over the goods have been passed on to the buyer, meaning to say the seller has no control over the goods. So if I have sold the goods, the customer has taken away the goods, it is in his control, then I can recognize the sale, right? This is similar to the a lot of concepts that I have learned in Sale of Goods Act as well. Similar concepts have been applied here. Property have been transferred, or risk and rewards of ownership have been transferred, and control of the goods have been control of the goods lies with the buyer. Now, the kind of question sometimes the twist and give it to you is advance have been received, property has been sold, everything has happened, sale date is pending, which has happened in the next financial year. Now, in that case, substantially all the things which are required for transfer of property has happened, and then in substance, applying the concept of substance over form, you can recognize the revenue. This is one kind of question which generally gets tested in the examination, right? So generally, property when it is transferred, then you can recognize the sale of the particular goods. Okay. When it is services, you either use completed service method or proportionate completion method. Proportionate completion is similar to the contracting that we have seen. Completed service method means, let's say you want to install a AC, right? Now, once the AC installation is complete, the service is completed, and hence you can recognize the revenue. Then interest is recognized on time proportion basis using accrual concept. Okay. Royalties, based on the agreement, you will recognize that. Dividend are recognized when the owner's right to receive the payment is established. So once the dividend is declared and then you are the shareholder on the record date, you are entitled to receive the dividend, then you can recognize the revenue of the dividends. See any specific question? I discussed one question with work in progress amount due from customer. What you can do is you can refer to our notes, or you can pick up one of the past exam questions, and if you have any doubt, you can ask us in the forum. Okay. You just remember that formula. You apply that formula in one of the past exam questions, you will be able to handle that. Rama Sesha Gopal. And if you are still having a doubt, you can please post it at our forum. We'll be able to help you out. Sir, if we find out that the cost exceeds the revenue, should we recognize the entire loss? Entire loss, no proportionate. Prudence concept means the moment you see there is a loss, recognize the entire loss. Not that I'll defer the loss over 3 years or 4 years period. No. Whatever is the loss, total loss will be recognized in the same period. Similar to the manner that 750 of loss, right? In the same manner what we have seen in the illustration. Okay. Then let us look at few specific examples from revenue, so that in examination, if a question appears from these, examples, these kind of situations, you are able to conclude. Now, whenever we are talking about revenue related questions, you must be in a position to define or explain when do we recognize revenue. In case of goods, how do we recognize? In case of services, how do we recognize? And whether those conditions have been fulfilled, and hence you are recognizing that revenue. Okay. Yeah. So buyer requests delivery but takes title and accepts billing. Okay. So buyer requests deferred delivery. It's not a buyer request delivery. Buyer wants delayed delivery. So even if delivery is not made but billing has happened and title has been transferred, then you will recognize the revenue. Goods sold subject to installation and inspection. Now, for example, I have ordered some item. Let's say I've ordered an air conditioner. Okay. And my condition to the seller is that, Mr. Seller, you have to install that AC in my premises. Only after successful installation, I accept the goods on my name, or I'll accept that this, I have purchased the goods, and then I'll make the payment. Till the time it is installed to my satisfaction, I am not accepting that you have sold the goods to me. In that case, only when I accept the goods, the installation, then the seller can recognize the sale. Okay. Sale on approval. Sale on approval once the customer approves. So, a lot of time it happens, right? You buy goods from Amazon and you have 10-day, return period. Till the time of that 10-day return period, you will not be able to recognize revenue because the customer has right to return. Customer has right to return, or they may recognize the revenue and make a provision for returns that will happen post the balance sheet date. That's also possible, right? So, sorry. So you have to see whether there is a sale on approval. So if approval is given, then you'll recognize the sale. Or let us say time has elapsed, 10-day period is over and you have not heard back. That means customer has accepted. Okay. Then if there are guaranteed sales, or if there are sales with warranty, then you will recognize the full sales and make an appropriate provision for warranties based on past experience. Then consignment sale. Consignment sale is when the consignee sells the goods, because consignee is your agent. So transferring the goods to the agent is not a sale. Only when the consignee sells it to a third party, you recognize the sale. Cash on delivery. Goods which are sold on cash on delivery basis. Only when you receive the cash, you will recognize the revenue. Series of installment payments by buyer leading to delivery only when the final installment is paid. So only when the final installment is paid, you will deliver, property is transferred, only then you can recognize the revenue. Hire purchase cases, you will follow the principles what you have learned in hire purchase accounting, right? Though the title gets transferred later, you can recognize the sale upfront. Right, then all of these are similar things. Installment, again, installment sales will be recognized immediately. For advertising agencies, if there is a media commission. So let us say we run advertisements and we have an agency. We pay some commission to the agency based on the ads placed in the media. Okay. So based on the number of ads being placed, or based on the amounts spent on the medias for advertisement, you give the commission to the media agency. So for that media agency, based on how we spend the amount on advertisements, they can recognize their commission on accrual basis, right? Then these are all straightforward ones, nothing significant here. Yeah, so let's look at this question. Arjun Limited sold its farm equipment through its dealer. One of the conditions at the time of sale is that payment of consideration is in 14 days, and in the event of delay, interest is payable at 15% per annum. The company has not realized interest from dealers in the past. However, for the year ended 31st March, it wants to recognize interest due on the balances due from the dealers. The amount is ascertained at 9 lakhs. Decide whether the income by way of interest is eligible for recognition. Now, generally, you would say if there is a condition of sale that interest is payable after 14 days, the entity can recognize interest. But in the past, the entity has not been able to collect interest, right? Or they have not realized. So the past experience shows that the interest is not realized, interest is not collected, which means the entity may not collect in the future unless they demonstrate that they will be collecting it. You will presume that the entity will not collect in the future, and hence you will not recognize the interest. If you collect it actually, then you can recognize. The board of directors of X Limited decided that on 31st of March to increase the sale price of certain goods retrospectively from 1st of Jan. As a result of this decision, the company has to receive 5 lakh from its customer, but the company's accountant is reluctant to make up his mind. Now you are going and increasing the price on a retrospective basis. Do you think customers will pay to you? Do you think customers will pay to you the increased amount? They will not, right? Today, as students of Indigo Learn, if I say we have increased the prices of our existing courses with effect from 1st of July of 2021, please pay us extra amount. Will you guys pay? You will not pay, right? So can I recognize revenue? We cannot recognize revenue in that case, right? So similar things of this here. This is one question which keeps on appearing. Okay, A Limited entered into a contract with B Limited to dispatch goods valuing 25,000 every month for 4 months upon receipt of entire payment. Okay, B Limited accordingly made a payment of rupees 1 lakh, and A Limited started dispatching the goods. In the third one, due to a natural calamity, B Limited asked A Limited to not dispatch goods until further notice. So please understand, A Limited has entered into a contract with B to dispatch. So A is dispatching, and what B said in the third month, don't dispatch. A Limited is holding the entire goods worth rupees 50,000 ready for dispatch. A Limited accounted 50,000 as sales and transferred the balance to advance received against sales. Comment on the treatment of the balance amount with reference to reference to the provisions of accounting standard. Now here, what if you say the sale is for 1 lakh, entire amount has been received, the contract has been entered into, and goods have been made ready, goods are ready for dispatch. At the request of buyer, we are not dispatching. So we can still recognize the sale for the entire amount because buyer has requested a delay in delivery. So from our side, our activity is done, money is received, the title has been transferred, just that the delivery is delayed, and hence still then we can recognize the revenue from sale of such goods. Okay, so we'll have these questions similar in lines, whatever we have been discussing so far. So we'll call it off the session here today. For these standards, if you have any question, you can let me know. I'll be happy to answer them. Or if there is any other from the standards. See, now on AS4 again, there are these 4 questions for 5 marks. Again, keeping in view the provision of AS4, each case you have to decide, right? So look at the case, apply the principle, and try to get a conclusion, right? I will cover AS18 also. That also will be doing. Under AS5, like you have to disclose extraordinary, items. Extraordinary items have to be disclosed. Changes in accounting policies have to be disclosed. Whenever there is a change in policy, what is the amount of impact of change in the current period, previous period, that's as per AS1 also, right? That needs to be disclosed. If you cannot quantify the amount, that has to be disclosed. Okay, so no other questions. I'll call it a day here.
Good afternoon, my dear students. Hello, hope everyone is good.
So we're good to go. Let me share the screen. Okay, so we move on to the next standard, which is Accounting Standard 17. Again, more of a disclosure and reporting based standard. Very little to compute in this standard as well. Now, time and again, questions have been tested as to whether a particular segment is a reportable segment or not, for which we'll have to check the criteria. And sometimes they may ask you to present, separate the revenue items and the assets items between different segments. Okay, largely again here, the test, the thing that is generally tested is whether a particular segment is reportable or not reportable segment, right? So now when it comes to segment reporting, what is a segment? Segment is a part of the business. Understand it the way you understood strategic management. There also we spoke about, there could be divisions, right? There could be multiple divisions, there could be business divisions, there could be geographic divisions. Same concept, you can apply it out here, where you understand or where you learn different business segments. Segments here, you can understand it as a division. So if there is a company which has, let us say, different product lines, each of the product line can be a segment. If I have to take an example of ITC, cigarette can be a segment, then hotels can be a segment, FMCG can be a different segment. That is what is a segment. Or sometimes if if a company has operations in different geographies, let's say some operations in India, some operations in the US, some operations in some European countries, each of them having different risks and rewards, having different kinds of risks for the business, they can be segments in a general sense, right? So what is a segment? We need to understand two kinds of segments here. One, what we call as a business segment, right? And the other one, what is called a geographical segment. What is a business segment? Business segment is a distinguishable component. So you can separate this component, or you can see this component separately, that is engaged in providing an individual product or service or group of related products or services. So basically, what are we looking at? A segment that is a component of the enterprise, which is providing different product or group of products, service or services. So as I gave you an example of ITC, FMCG is a different group of products. Cigarettes is a different group of products, right? That can be a business segment. And the key condition is these are subject to risk and returns that are different from those of other business segments. So FMCG will have a very different risk and rewards or risk and returns versus that of a cigarette. So each component which has a different risk and return and which provides individual product or group of related products or service or group of related services is called a business segment. So this is one term that you need to understand in this standard. What is a business segment? Then what is a geographical segment? So geographical segment is a component again which is providing products and services within a particular economic environment. So there is an economic environment, like I gave you an example, India, then there could be US, there could be Middle East, right? Each one is a specific economic environment that is subject to risk and returns that are different from those of components operating in other economic environment. So what does this mean? They're operating in a geography which has a different risk and reward as compared to other geographies. In a nutshell, that is what is being told. Now, when we identify geographical segments, you have to see maybe different political conditions. Some of the West African countries, there may be a lot of political instability. That could be a different segment, right? China has a different set of rules altogether, right? That can be a different geographic segment, right? So all of these things, these factors you keep into account and you try to identify what is a geographical segment and what is a business segment. Now, sometimes what happens is when it comes to business segments, you can combine two or more business segments. You can aggregate them if they have similar characteristics, like the products or services are similar, the production process is similar, the customers that you're serving are similar. So in that case, you may aggregate. Okay, so that aggregation can happen if there are same products or similar products and services. Not much of a relevance as far as accounting aspects are concerned. Yeah, but when you have to take decisions, similar kind of products, similar kind of services can be aggregated, right? Then, okay. Now coming to the next aspect, which is a reportable segment. Now, what is a reportable segment? A reportable segment is a segment. It can be a business segment or it can be a geographical segment, right? For which we need to give segment related information as per this standard. What is a reportable segment? Reportable segment is a segment for which we need to provide segment related information as per this standard, right? Now, these we have discussed, right? Now, how do we define the reportable segments? How do we define reportable segments, or how do we decide which segment are reportable? Now, it could be a business segment, it could be a geographical segment. We'll understand which one to be reported first. But then, when do we say that a segment is reportable, right? A segment is reportable if you can use the revenue criteria. If revenue from sales to external customers and from transaction with other segments is 10% or more of the total revenue, external and internal, of all segments. Now, what does this mean? You take the total revenue, of all the segments, and you check those segments whose revenue from sale to external customers as well as with the other segments is 10% or more. This is called revenue threshold criteria, where you have to check whether the segment revenue is 10% or more of the total revenue, right? Then segment result is 10% or more. Now here I want you to pay a good amount of attention, where we are saying revenue 10% or more. Please note, it is 10% or more. It is not 10%. It is 10% or more. It is not greater than 10%. Then results also 10% or more. Now this result could be profits or losses. So what you have to do is you have to aggregate all profits, aggregate all losses. So take summation of all profits take summation of all losses, ignoring the negative sign, and at the end, so you take all the sum of profits. That is, sum of all profits is 200, sum of all losses is 350. You apply 10% on higher. You apply the 10% threshold on the higher one. So here higher is losses, so you will see 10% of 350, which is 350 multiplied by 10%, which comes to 35. Now any segment which has result of 35 or more, that is either profit of 35 or more or losses of 35 or more, that becomes reportable segment, right? Any doubt in these two conditions? Okay, so there's a question, what am I going to cover today? I'm going to cover AS 17 onwards, so 17, 18, you have 19, then we'll cover accounting standard 20, 22, then I think 24, 26 and 29 to the extent time permits. Okay, so no questions here, right? Then after this, you have to check for the third condition, which is the asset condition, where its segment assets are 10% or more of the total assets of all segments. So here you have to take the assets of all the segments. Again, you have to say 10% or more. Okay, now where students make mistakes is generally here. It is profits taken separately, losses also taken separately, and then calculate 10% on the higher amount. Okay, now this is the general principle. You have to take segment revenue 10% or more, sales to both external customers as well as from transactions with other segments, 10% or more of that. Segment result, that is segment revenue minus segment expenses, the segment result is 10% or more, and segment assets are 10% or more of the total assets of all the segments. These are the principal guiding criteria. Now apart from this, if the management thinks that okay, this particular segment has to be reported as a separate segment, can they do that? Can the management report a segment which does not meet any of these three criteria? Can I get a quick answer on this? Okay. Yeah, I'm getting the responses now. Others, do you think we can report a segment which does not meet any of these three criteria? Yes. Yes. Okay. So you have the clarity. We can report segments which does not meet any of these three criteria. That is at the management discretion. So either first condition or second condition or third condition or management decision or management discretion can be a question in the examination. Can they report if they want? Okay, that is the next aspect. Then you have to ensure that 75% of revenue is covered with those segments that are being reported. Now what do we mean by that? Let's say there are segments A, B, C and D. Okay, now while taking into account, we get only, let us say the criteria are met only by A and B based on segment revenue, segment assets, segment results. Only A and B are reportable segments and C and D are non-reportable segments. You have to ensure that when you are giving segment information, 75% of the revenue should be covered by these two segments. If they do not cover 75%, then you have to keep on adding more segments till the time you reach the 75% of the revenue criteria. So the next aspect is, if the total external revenue attributable to reportable segment, so we are only talking in terms of external revenue, not inter-segment revenue. If the external revenue attributable to these segments constitutes less than 75% of the total enterprise revenue. So let us say the enterprise is reporting a revenue of 200. Each of the segments external revenue, when you aggregate the reportable segments, they have to be at least 75%. That is 200 multiplied by 75%, 150. So 150 should be reported as individual segment revenue. So A and B put together, let us say external revenue for A is 50 and for B is 60. So 50 plus 60 means what? Only 110. And let us say this is 20 and this is, oh, if I say 70, it meets the criteria. So say for example, this is 40 and this is 40 for argument's sake. Okay, and there are other segments also. So 50 and 60 is 110. You have to ensure that you at least take it to 150. So you will include C also, and residuary segments can be ignored for reporting purpose. Okay, so now this 75% revenue criteria is important. So what you do is you take A, the threshold criteria, you take management discretion, and even after that 75% of external revenue is not being reported, then you keep on adding more and more segments till the time you reach the 75% threshold. Then what are segment revenue? We said, right, segment revenue. Segment revenue is the portion of enterprise revenue that is attributable to the segment. So what the segment is getting revenue out of its own, then directly attributable, which can be allocated, and revenue from transactions with other segment. So when we are saying segment revenue, it includes both internal revenue as well as external revenue. But for the 75% criteria, you have to take only and only the external revenue and check that particular criteria. And also, segment revenue does not include extraordinary items, prior period items, and changes. Segment revenue does not include extraordinary items, interest or dividend income, right? So if there are interest or dividend income, that is considered to be the enterprise revenue rather than the specific segment revenue, unless you are talking of companies like banks. Let us say bank, the primary income itself is interest, right? So there you will not apply this exclusion, but generally interest or dividend income will be excluded. Then gain on sale of investments, will also be excluded unless your operations are itself of a financial in nature. So if it's a normal company, then sale on investment, whatever are the gain that we get, those will not be attributable to the segment. Also, if a debt has been extinguished, there is a loan taken and that loan has been written off by the banker for whatever reasons, there is a gain on this loan, then in that case that gain will also not be considered as a part of segment revenue. Okay, then expenses are pretty straightforward, just the opposite of whatever we have learned in terms of revenue. Now specifically exclusions for expenses, again extraordinary items are excluded, interest expense are also excluded. But when will we include interest expense? If the nature itself is a financial nature, the operations itself are of financial in nature. Then losses on sale of investments, those are also excluded. Income tax expenses are also excluded, and general administrative expenses, other expenses which are relating to the enterprise as a whole, those are also excluded. Then segment assets are those assets which are employed by a particular segment, which are directly attributable to the specific segment. Those are called as segment assets. And segment results are segment revenue minus segment expenses. Now in the examination, you are not expected to understand in depth of each of these aspects. Generally, the kind of questions we have been seeing from this standard is, the one is whether a segment is reportable or not, and second one is to prepare that segment wise reporting, which is just a extension of the normal P&L. Any questions here? Let me just check if anyone has any questions. You can add any segment. So there is a very good question. Can we add any segment? Yes, you can add any segment. You can add any segment, which one is to ensure that you reach that 75% threshold. Okay. Now we said that there could be business segment and there could be geographic segment, right? There could be business segment and there could be geographic segment. Now you have to decide the primary reporting segment. Primary reporting segment. Primary means the main, and then secondary reporting segment. Now what is a primary one? Now if you have both business segment and geographic segment, one of that should be the segment which better represents the organization, which better represents the business enterprise. That becomes the primary segment, and the other segment becomes the secondary segment. Now, if I have to call business segment as the primary segment, then the risk and returns of the enterprise should be primarily dominated by difference in products and services. If I have to call it a geographic segment, then the geographies determine the risk and enterprise. They are the dominant factors. So you have to choose which one is primary and which one is secondary. Okay. Now, is it possible that a company has both primary and secondary segments? Yes, both of them may be possible. In that case, what you have to do is you have to decide which one is to be primary, and then you have to decide which one is the secondary. Okay. Now, sometimes organizational structure can give a representation that which is the prominent one. If they are following, let us say, geography based divisional structure, then geographic segment can be termed to be primary. Or if the business, the products are the basis of divisions, then product can be primary. And sometimes there can be a matrix presentation. There can be a matrix based presentation where both of them are equally dominant, very rarely seen, but if both of them are really dominant, then you can follow a matrix presentation as well. So this flow chart summarizes whatever we have been discussing. You can get it from the notes, right? Then for each reportable segment, under the primary reporting format, you have to disclose revenue from external customers, inter-segment revenue, what is the segment result, what is the carrying amount of segment assets, segment liability, capex, depreciation, non-cash expense, then share of profit or loss in associate and joint venture, not much applicable to you guys, investment and reconciliation. Then if there are any extraordinary items which need disclosures, that have to be given. Then you can give cash flow statements, again, segment wise, and reconciliation. Now, reconciliation means what? The entity would break down the total enterprise revenue, for example, into different segments, right? That has to be reconciled, means you have to show what is the total revenue of all the segments plus or minus whatever has been allocated to other segments. Then it has to finally match with the enterprise revenue. That reconciliation statements has to be presented. Then if primary format is a business segment, you have to report something in the secondary format for geographic segment. So if primary is business, you will report segment revenue from external customers by geographical area based on the geographic location, where revenue from sales to external customer is 10% or more of enterprise revenue. Now, please understand, this can be a theory question. Primary reporting format is done. It is a business segment. From each geography where you are getting more than 10% of the enterprise revenue, that has to be reported separately. Then total carrying amount of segment assets by geographical location for each segment whose segment assets are 10% or more of the total assets of all the geographical segments. Again, 10% or more of enterprise revenue, whichever segment has, that has to be reported. Then 10% or more of assets which has, that also has to be reported. And total cost incurred during the period to acquire segment assets and are expected to be used during more than one period. So basically, what are the additions to fixed assets? What are the costs incurred on fixed assets? That also has to be disclosed. Again, now this disclosure is needed for those assets which meet this criteria of 10% or more of geographical assets. And if geographical segment is the primary reporting segment, then for each business segment whose revenue from sales to external customer is 10% or more of enterprise revenue, or whose segment assets are more than 10% of total assets, the following information. Again, revenue from external customers, carrying amount of assets, and total cost to acquire segment assets. Right? So these are the key aspects which are important as far as your accounting standard 17 are concerned. Any doubt so far? Now moving on to the next standard, which is again more of a disclosure standard, which talks about related party disclosures. The standard itself says related party disclosures. Disclosures meaning certain information which has to be disclosed. Now there is a necessity to disclose related party disclosures because users should be aware what are the transactions and entities entering into with related parties, right? Now, what are related parties? Who is a related parties? Parties are considered to be related if at any time during the reporting period, please note this word, if any time during the reported period, one party has ability to control the other party, or one party has the ability to exercise significant influence over the other party in making financial or operating decisions. Who is a related party? Parties are considered to be related if any time during the reporting period. So if you're talking from 1st April 21 to 31st March 22 or 1st April 20 to 31st March 21, during the year, even for 1 month, if one party had the ability to control the other party, so control, what is control? We'll come to control, or exercise significant influence over the other party. So either you are controlling or applying or having significant influence over the other party in making financial or operating decisions. So if there is control, now when is control? Control is, let's say there is a holding subsidiary relationship. So there is a control element involved. So if there is a control element involved, then there is a related party relationship. Or there is a significant influence, then also there is a related party relationship, right? So this is the key definition of related party relationship. And what are related party transactions? These are the transfer of resources or obligations between related parties, regardless of whether or not a price is charged during the period of existence of such relation. So if there is a transfer of resource, let's say you have paid some amount, or if there is a transfer of obligation, that some liabilities have been transferred between related parties. So between related parties, there is, let's say, a purchase and a sale transaction. Between related parties, there is, let's say, guarantee being given. Between related parties, let us say there is some salaries being paid. Then during such period, when the relation was existing, those are called related party transactions. And this is what is the focus of the standard, that you have to disclose related party transactions. We'll come to the format of disclosures, but if there is a related party relationship, or there is a relationship of related parties, then, and there are transactions between related parties during the relation, then you have to disclose the facts and you have to disclose those transactions. Whether or not price is charged, what does this mean? Say, for example, a director gave free services, consulting services to the company, or a related party gave free advisory services to the company. Price is not charged, but still you have to disclose the fact in the financial statements. Now, we talked about two aspects. Control. What is control? Control comes from various different angles, largely when we talk about a holding subsidiary relationship kind of a thing. So first, if there is ownership of more than 1/2 of the voting power, so there is a holding subsidiary relationship, there comes the question of control. Or you can control the composition of board of directors or governing body of any enterprise, meaning to say the one company does not have more than half of voting power of another company, but the first company can control the composition of board of directors. So what are we trying to say here? Let us say there is company A, company B. First thing is they have more than 1/2 of voting power, okay, or they are controlling the composition of whom? of board of directors or governing authority. Now see, when you control the composition of board of directors, indirectly you are controlling the company. So control exists in those situations as well. Okay. And otherwise, there is a substantial interest in voting power. There is no control. It doesn't reach the 50% threshold, but there is substantial interest in voting power and the power to direct. So see here, you need to meet both the conditions. Substantial interest in voting power and the power to direct by statute or agreement the financial and operating policies of the enterprise. So in the third condition, you have substantial interest in voting power and the power to direct. Power to direct again means you are in a position to give instruction. Again here, control is established. Right? Now, apart from this, there could be significant influence. There could be significant influence. So one is control. So if you go back to the definition, we said there are parties considered to be related if there is control or significant influence. So we are coming to the second aspect. Significant influence means participation in the financial or operating policy decision of the enterprise, but not in control. So one aspect is control, where you are controlling. Second aspect is significant influence. We are influencing. We are not controlling, but we are influencing. Generally, when an entity has 20% or so voting power in the other entity, then we can say that there is a significant influence. Myself, I am not able to control. I cannot say yes or no, but I can influence the decision of the other company. There comes the question of significant influence. So to summarize, voting power more than one half, BOD composition, board of director composition, and substantial interest. We talked about it, significant influence plus power to control operating and financial aspects. Then there comes the question of control. Otherwise, if there is only substantial interest, and you do not have, other aspects to control the entity, then that falls under the category of significant influences. Any questions so far? Because this is one thing where a lot of students do have doubts. Okay, nothing else. Now, this standard deals specifically with some specific kinds of related party transactions. Okay, so we understood that, related party, what is the meaning of related party? What are related party transactions? These standards deal with specific kinds of related party transactions. Okay, now the first one is enterprise that directly or indirectly through one or more intermediaries control or are controlled by or are under the common control with the reporting enterprise. So what does this mean? Let us say there is A Limited, there is B Limited. A Limited is the holding company, B Limited is a subsidiary company. Right? Now, this relationship is covered by the standard enterprise that directly they control. Or let us say A Limited subsidiary is B Limited. B Limited has one more subsidiary, which is C Limited. So A Limited is directly controlling B Limited, and A Limited through B Limited is controlling indirectly C Limited. So enterprise that are directly or indirectly through one or more intermediaries control. So they are controlling or are controlled by. So one is looking from top, A Limited controlling B. So for A Limited, B Limited is a related party. B Limited is being controlled by A. So for B Limited, A Limited is the related party. Again, come to C Limited. C Limited is controlled by B Limited. So B Limited is a related party. C Limited is indirectly controlled by A Limited. So A Limited also becomes the related party for C Limited. Or are under common control. Common control means what? Let us say there is one more company called D Limited. Now D Limited is also controlled by, say for example, A Limited. Okay, so D Limited is also controlled by A Limited, which means B Limited is also controlled by A Limited, D Limited is also controlled by A Limited, B and D are under common control of A Limited, and for B Limited, D becomes related party, for D Limited, B becomes related party, right? So this is the crux of the first part, where an enterprise that are directly or indirectly through one or more intermediaries are controlled or are controlled by one or under the common control of the reporting enterprise. So what are we talking about? Company, subsidiaries and fellow subsidiaries, all of them become related parties. Then associates and joint ventures of the reporting enterprise. So if there is a associate, now associate is when there is 20% investment or more, but not control, so less than control. So it's not to the extent of control where we have more than half of voting power. It is only a some quantum of investment. This does not lead to control. We classify them as associates. So there are associates or joint ventures. So two companies coming together and starting a common another company, which is defined as joint venture. Then these are also related parties. So if there is an associate of A Limited, then the associate becomes a joint venture. So in this case, let us say there is an associate of A Limited. Let us say we have E Limited. So if E Limited is an associate, then E Limited also becomes a related party. Or let us say there is another company called J Limited, which is a joint venture. It is a JV. Okay. Now, if J Limited is a joint venture, then this particular J Limited also becomes a related party for A Limited. And the other party which has invested in J Limited, which is a joint venture, then that also becomes a related party. Okay. So this clarifies the first two aspects. Then individuals owning directly or indirectly an interest in voting power of the reporting enterprise that gives them control or significant influence over the enterprise, and relatives of any such individual. What does this mean? Individuals who have either control. So let us say, as an individual, I own 51% of another company, of a company. So I have control. So I become a related party. Or I have significant influence. Then also I become a related party. Or relative of any such individuals, they also become related parties. And key management personnel or relatives of key management personnel. Now see, this sometimes becomes too much of information to be processed when you're looking at examination. You have to understand each head separately. First one talks about holding subsidiary relationship. This one talks about associates and joint ventures. This one talks about individuals who own an interest which either gives them control or significant influence, and relatives of such individuals. And lastly, key management personnel and relatives of such key management personnel. Yeah. Now, important aspects here. Relatives. Who are relatives? Relatives means spouse, husband or wife, son, daughter, one level down, brother, sister, siblings, father and mother, one level up, who may be expected to influence or be influenced by that individual in his or her dealings with the reporting enterprise. So, two things. As an individual, my wife, if I am a related party, then my wife also becomes a related party. When the spouse is in a position to influence or be influenced. So let's say wife can influence me in my dealings with the company, then related party. Or I can influence my wife when she is dealing with my company, then again wife becomes a related party. So this is how you need to understand. Okay. Then who are key management personnel? These are the people who have the authorities of planning, directing and controlling the activities of the reporting enterprise. Generally, in exams and all, you'll get things like director, managing director, full-time director, right? All of these are key managerial personnel having key positions in the organization, who largely take the decisions related to the company. They are the ones who run the company. You can think it that way. Actually, shareholders run, but the large part of the decisions are taken by these key management personnel. So directors and all of those things fall into this particular category. Okay. Now, one more thing, when it comes to associate, joint venture and subsidiary, If subsidiary criteria is not met, and if joint venture criteria is not met, then you put them into the residuary category of associate companies. Then we spoke about related party transactions. Then what has to be disclosed when there is a related party relationship and transaction? You have to disclose related party relationships. So who is the related party? What is the nature of related party relationship? And two things you have to take note here. If there is control, if related party disclosures are coming because of control, then you have to disclose whether or not any transactions have happened. But if it is coming without control, if it is coming other than from control, then you need to disclose only if transactions have happened. Now, why this is important is, say for example, there are 5 directors in the company. Now, those 5 directors in the company, they have so many relatives, husband is there, spouses, brothers, sisters, and all of those things. You cannot keep on adding names of all the relatives of the directors of the company. So for that purpose, if the related party relationship where control exists, you have to disclose the name and the nature of related parties. If control does not exist, then when there is a transaction that is happening, in that case, you will disclose the name, nature, relationship, and then the transaction details. Okay. And if related party transactions have happened between related parties during the related party relationship, please note only the transactions when the related party relationship existed, then you have to disclose the name, the relationship, the description of nature of transactions, volume, either as an amount, generally amount is disclosed, any other elements of the related party transactions which is necessary for better understanding of the financial statements. Then outstanding items, let's say loan has been given, what is the amount of loan outstanding, and if you have written off any amounts in that period, you have to disclose that. And sometimes what companies do is, because there are lots of related party transactions, they can group similar items according to the type of the related party. But if separate disclosure is needed, that has to be given out separately. So this is again important. Related party relationship, disclose whether or not, only when control is there, whether or not transactions have happened. And whenever there is a transaction, disclose these aspects: name, relationship, nature of the transactions, volume of the transactions, any other disclosures, outstanding amounts, and amounts written off or written back. Okay, so this covers in crux AS 18. Now let's move on to the next aspect of AS 19, which talks about accounting for leases. Now, in accounting for leases, I'll be focusing only on the most critical aspect, that is segregation between finance lease and operating leases. That is the one aspect which we'll be talking about. And finance leases accounting related aspects, that is one thing we'll be talking about. And obviously, towards the end, we'll take up the sale and leaseback related provisions. Okay, so what is lease and all? So lease is an agreement whereby lessor conveys to the lessee, in return for a payment or series of payment, right to use an asset. So there is a right to use an asset given by the lessor to the lessee in return of payment. Okay. Now leases are of two types. One is called the finance lease. The other one is called the operating lease. Now, what is a finance lease? Finance lease is where risk and rewards incidental to ownership is transferred. Say for example, I have taken a car on lease. The car's useful life is 10 years. I have taken the lease of the car for 10 years, meaning to say in the entire life of the car, I will be getting the benefits which are incidental to risk and rewards of ownership. And finance lease, the classification and the accounting deals with the concept of substance over form. Legally, the lessee may not be the owner. Legally, the lessee may not be the owner, but in substance, we treat as if the lessee has been the owner, and hence, whenever there is a finance lease, we consider it to be a sale transaction. There is a sale transaction and there is a kind of a loan transaction. Under finance lease, we have sale transaction and a loan transaction. Why sale? Because we assume that though legally the asset has not been sold, but substantially risk and rewards of ownerships have been transferred, and hence applying the concepts of substance over form, we treat it as a sale transaction. And why loan? Because payment has not come upfront. You have not got the full payment upfront. That is why it becomes a kind of a loan transaction. So there is a sale transaction, there is a loan transaction as far as the lessor is concerned. As far as the lessee is concerned, there is a buy transaction and a borrow transaction. So I'll call it sale and lend. That makes it easier. So what is a finance lease? Where risk and rewards incidental to ownerships have been transferred. What is an operating lease? An operating lease is a lease which is not a finance lease, which means the risk and rewards incidental to ownership have not been transferred. Now, how do we decide whether the risk and rewards incidental to ownerships have been transferred or not? For that, we have certain conditions which we need to check, right? So let's go through those conditions quickly. Right. Now, these five conditions needs to be satisfied, any one of them, not all of them, which indicates that the lease in essence is a finance lease. Now, first one, there is transfer of ownership at the end of the lease term, meaning to say, I have taken the asset on lease. For example, I am the lessee. I have taken the asset on lease. At the end of the lease term, the asset becomes my asset, which means in substance, when the lease transaction was entered into, there is actually a transfer of all the risk and rewards, because finally I will be the owner. And hence whenever there is a transfer of ownership of the asset to the lessee by the end of the lease term, we call it as a finance lease. Then there is no transfer in the agreement, but there is an option to purchase. There is an option to purchase at a price under which the lessee is likely to exercise that price. Generally, we call it a bargain purchase option kind of thing. For example, at the end of the lease period, the asset is worth 1 lakh. But under the contract, under the lease agreement, the lessee has an option to buy that particular asset at 30,000. So who will not buy an asset worth 1 lakh at 30,000? Which means the lessee has an option to buy, which the lessee is likely to exercise. So in both these cases, we are looking at a situation where the lessee will be the eventual owner of that asset, either by transfer of ownership or under the option to purchase. There will be a transfer of ownership or title at the end of the lease period. So what the standard says is, yes, at the end of the lease period, there is a title transfer. In substance, you are title, there will be a transfer title. In substance, you can consider that the title has been transferred today, and hence the lessor will recognize it as a sale and the lessee will recognize it as a purchase. Then lease term is for the major part of economic life. I gave you an example. I took an asset on lease, car on lease. Useful life is 10 years. Lease period is also 10 years or 9 years. So significant portion of the asset's life is, as a part of the lease contract. In that case also, we call it a finance lease. And then if the present value of the minimum lease payments, will come to what is minimum lease payments. The present value of the minimum lease payments at the inception of the lease amounts to at least substantially all of the fair value of the leased asset. That is to say, the present value of minimum lease payment is equal to fair value. Now, there may be 5% here and there. There may be 95% also is fine. 90% is also fine. But substantially, major part of the fair value is recovered by ways of minimum lease payment. And lastly, the asset is of specialized nature such that only the lessee can use it. Meaning to say, you have done something customized. You have customized something for the lessee. Now, apart from lessee, nobody else can use it. Even such assets can be called a finance lease. This question has come up repeatedly in the examination as to when an asset can be classified as a finance lease. Yeah, for leases, I'll be taking up an illustration to help you calculate the present value and all of those things. Okay. Now, what is minimum lease payment? What is minimum lease payment? Minimum lease payments are the payments over the lease term that the lessee that the lessee will pay excluding contingent rent, cost of services and taxes. So if there is anything which is contingent, percentage of sales based payment, that you will exclude. Then if there is any maintenance related thing, that will be excluded, taxes etc. will be excluded. So payments over the lease term that the lessee will make. So let us just note this down. MLP will include periodic lease payments, a monthly rental or yearly rental or quarterly rental, whatever the lessee is required to pay, and any residual value guaranteed by or on behalf of the lessee. So guaranteed by whom? Lessee, or on behalf of lessee. So let us say at the end of the lease period, I have taken a building on lease. At the end of the lease period, I have to pay a certain amount when I vacate the lease, right? That is guaranteed as a part of the contract. Maybe for, taking care of repairs or refurbishing or whatever it is, or I will take up some furniture along with me. For that, I'll pay some amount. Whatever it is, there is something which is guaranteed. So these are the things that lessee is bound to pay. Lessee has to pay. Lessee has to pay. These are called minimum lease payment. But if there are certain contingent rents at the time of contract, you have defined something like 5% of sale will also be paid by lessee to the lessor. Now, those are contingent payments. Those are not included. Okay. This is MLP for lessee. Then we have MLP for lessor. What is MLP for lessor? You include lessee MLP and you include the third party residual guarantee. You include the third party residual guarantee. What does that mean? You take MLP for lessee, then you add to this third party residual value guarantee. Now that guarantee has to be come from someone who will be able to fulfill that amount, or who will be able to fulfill the guarantee. It should not be from some random person or a person who is not in a position to pay off that amount, right? So for lessor, you will take all the things which are there as a part of lessee, and you will also add any third party residual value which is guaranteed. Now, after having understood this, minimum lease payments for lessor and as well as lessee, we have to see that whenever we are talking about a finance lease, the minimum lease payments, now this has to be from lessee's point of view. Minimum lease payments by the lessee is substantially equal to the fair value. Now, what is the fair value? Fair value is the fair value of the asset on the date on which the lease transaction is entered into. Now, you have this, right? Between knowledgeable parties, without any force and all of that, you enter into transaction. The value between knowledgeable party in an arm's length transaction, that amount is called fair value, right? So if the minimum lease payment is substantially equal to the fair value, then we call it a finance lease, right? Then we spoke about guaranteed residual value. Now, coming to the two important aspects: gross investment in the lease. Gross investment in the lease is nothing but, what does this include? Gross investment in lease includes minimum lease payment from lessor's point of view, plus unguaranteed residual value. Meaning to say, whatever the lessee will pay plus whatever the minimum residual guarantee which is given by lessee, that plus any residual guarantee given by third party, that plus any unguaranteed. See, there will be some scrap which will be left over at the end, including the value of that, whatever is there, that is called gross investment in lease. Gross investment in lease, right? So you may be asked to compute gross investment in the lease in the question. And then what is net investment in lease? From gross investment in lease, you reduce this finance income part. You reduce gross investment in lease minus unearned finance income gives you net investment in lease. So this number that you get here, the gross investment in lease minus unearned finance income gives you net investment in lease. Now, how do you decide this unearned finance income? You have to compute an IRR. You have to compute the implicit rate of return in the lease transaction. Using that rate, you will discount and arrive at the net investment in the lease. So The interest rate in the lease is the discount rate at which the present value of MLP from lessor's point of view. And always remember, the implicit rate in the lease is computed from the point of view of the lessor. And even when lessee is discounting, the lessee will use implicit rate of return of the lessor. And if that is not known, we will use the incremental borrowing cost. Okay. So present value of minimum lease payment of lessors, that is lessee's payment plus guaranteed plus unguaranteed RV. This present value is equal to the fair value of the leased asset. This is what is the implicit rate of return. So implicit rate is the rate at which present value of MLP from lessor's point of view plus unguaranteed residual value is equal to the fair value of the leased asset. Okay. Now coming to the accounting aspects. Finance leases. Finance leases. So let me do one thing. Give me a moment. I will take up a problem so that you will be in a better position to understand how do we do the accounting for it. Okay. So I'm taking one example just to illustrate to you how it is computed. Okay. So say for example, we have annual lease rents of 50,000 per year. $50,000 per year for 5 years, and it is paid at the end of the year. So always in the examination, what you do is you consider 0 as today, 1 as at the end of the year. So 1, 2, 3, 4, and 5. Okay, and you have annual lease payments of 50,000 in each of these period. Okay, then guaranteed residual value is 25,000. So at the end of the 5th year, there is a guaranteed residual value of 25,000, and there is an unguaranteed residual value of 15,000. Okay. Fair value at the inception of the lease is 2 lakhs. 2 lakhs. Okay. Interest rate implicit in the lease is 12.6%. So IRR is 12.6%. Okay, IRR is 12.6%. Now, if we have to calculate the present value of minimum lease payments from the standpoint of lessee, so when we go to accounting treatment for lessor and lessee, we need to see what is the present value of this minimum lease payments from the standpoint of view of lessee. So, from lessee's point of view, okay, this 12.6 rate is the rate considering the lessor side. What the lessee will account for it? Lessee will consider the same rate and discount this various lease payments to arrive at the present value. Now, please note this is GRV and this is unguaranteed residual value. Now, is the lessee concerned about this unguaranteed residual value? The lessee is not concerned. So, this will be excluded. So, what will you do? You will ignore this and then compute the present value. So 12.6 is 1 divided by 1.126. We can use it on a calculator and keep on pressing equal to 1 divided by 1.126, so on and so forth. If you calculate, you get the various discount factors, or they may give it to you in the examination also. If they give, then use what is given in the examination, right? So what is the present value? 50 multiplied by this. If you do, you get 1,91,400. 1,91,400. Now you may get a doubt as to why this 1,91,400 is not equal to fair value, because we are not considering this unguaranteed residual value. So if we add this unguaranteed residual value as well, right? And if you add these two, then you get almost 2 lakhs. That is the, using the, IRR approximation tool, there is a difference. So if you add this, you are unguaranteed residual value, then you will get 2 lakhs. Okay. So this is how we compute the present value of minimum lease payments. Okay, right. Now, what does the lessee do? The lessee, what it does is, at the inception of the lease, the amount, that is whatever is the fair value of the asset or whatever is the present value of lease payments from lessee's point of view. So as far as lessee's accounting is concerned, we are concerned with this present value of MLP from lessee's point of view. From lessee's point of view, which is 1,91,403, that will be recognized as a leased asset or finance leased asset and a corresponding lease liability. But if the fair value is less, which is unlikely the case, but if the fair value is less, then you will take the fair value. So the lessee will recognize the asset at lower of fair value of leased asset and present value of minimum lease payment. If, now again one more thing, this IRR, as I told you, this 12.6% is from lessor's point of view. And if the lessee does not know what is this IRR, then what should the lessee do? The lessee should use something called as incremental borrowing cost or incremental borrowing rate. So whatever is the incremental borrowing rate, using that rate, you will do the discounting. So what will be the entry? Sorry, guys. Asset account debit by 1,91,403, lease liability account 1,91,403. Okay, this is what is the entry at inception of the lease. Then you can prepare a schedule, just to help you understand. Year, opening balance, interest, payment, closing balance. So 1, 2, 3, 4, 5 years we are talking about. What is the opening balance? Opening balance is 191,403. Interest at 12.6% for the year. Payment is 50,000. Closing balance is opening balance plus interest minus payment, which is 1,65,000. Next year opening balance will be 165. Interest will be 220, which is 165 into 12.6%. Okay. Payment is 50, closing balance is 136. So like this, you can keep on preparing the schedule. In the last year, payment will be how much? 50 plus 25, 75,000. So 75,000 is the payment, which results in the closing balance of 0. Okay. So every year, this is out of the total payment. 50,000 is the total payment minus 24,116, 25,883, and so on and so forth. This part is towards the lease liability, and this part is toward the interest payment. Okay. So this is how the lessee does the accounting largely. Who will charge the depreciation? Depreciation will be charged by the lessee generally on the SLM basis over the period of the lease. If the useful life is less than the period of the lease, then you will restrict yourself to the useful life. Okay. So the SC will charge finance expense like what we have computed here. So when payment is done, for example, first year payment, lease liability, debit, interest expense or finance charges, debit, to bank. To bank will always be the amount that is paid, 50,000. How much is the interest expense? For the first year, take the interest expense, and then balance will go to the reduction of lease liability. Depreciation on this value, you will calculate over the period of 5 years. You can divide it by 5, and every year the depreciation can be charged. Okay. Now, as far as operating leases are concerned, whatever we discussed so far is for finance lease. This capitalization, bringing asset into the books of accounts, creating lease liability, all of these are relating to finance lease. But as far as operating lease are concerned, in operating leases, you will follow SLM method unless some other method can be justified. So total lease payments divided by number of years, whatever is the amount that comes, that will be recognized as expense in the P&L. Whatever is the difference between this expense and the amount actually paid, that will be credited to lease equalization reserve. Any questions on this, lease? Because lease is one concept where a lot of students find difficulty in, solving them. Do you have any questions on leases? Okay, no questions asked. Fine. Then coming to lessor. In lessor books, you will de-recognize the asset and you will recognize lease receivable as asset. Now, what is this lease receivable? This is the net investment in lease. Lease receivable is the net investment in lease. Now, you may have a doubt that what if this net investment in lease is different from the present value of lease payments from lessee's point of view? That is very much possible, because in the net investment in lease, please note, we'll also include this unguaranteed residual value, whatever is the present value. Okay, so for the lessee, the lease receivable will include this unguaranteed residual value also. As far as CA Inter is concerned, I don't think the examination will ask you such twisted questions, but unguaranteed, the lease receivable is always accounted for at this amount of net investment in lease, which is present value of all of the gross investment in lease minus unearned finance income, where you use the implicit rate of return. So whatever is the difference, that is captured as net investment in lease. So this is recorded as net investment in lease. On this, you will earn finance income. On this, you will earn finance income. You'll keep on adding those finance income, crediting that to the P&L. And whatever is the amount that the lessee pays you, whatever is the amount that the lessee pays you, that is the amount you will reduce from the net investment in lease or the lease receivable. Okay. So here, lease receivable would be $199,690, and on this you'll keep on calculating interest. At the end, there will be a residual balance left, which will be your unguaranteed residual value. Okay, so lesser accounting is generally not tested, so I'm not putting too much of emphasis out there. Lessee is what is tested more in the examination. This has been the pattern by the institute. Now, sometimes the questions can be about classify between an operating lease or a finance lease. So that can be a question. And then there is an important aspect of sale and leaseback. That is what we'll be touching upon now. Now, what is the sale and leaseback? Sometimes companies may be in need of money, but they are not in a position to get loans, or they don't want to sell off that asset and realize money, because they also need the asset. So there will be two transactions. Let's say there is lessor or owner, buyer. Okay, what owner does is owner sells the asset to the buyer. So here you have sale transaction. Here you have sale transaction, and then what the buyer does is buyer will give it back to the original owner, saying that this is a lease transaction. Very simple. As a package, these are not independent transactions. As a package, the original owner sells the asset to the buyer, and the buyer leases it back to the owner, that original owner. Now buyer becomes the new owner. Buyer becomes the new owner. Okay. Original owner now becomes the lessee. He becomes he or she lessor. Okay. So as a packaged transaction, there is a lease from the owner to the new owner, that is the buyer, who will in turn lease it back to the original owner. Now, what is the need of such transaction? You get immediate financing. When you make a sale, you get money, right? You get some amount. The owner gets some money, and the asset is leased back, for which the owner has now will start paying the monthly lease payments, or periodic lease payments, whatever the case may be. So now, why do we need a specific accounting treatment for sale and leaseback transaction? The simple reason being, as far as sale and leaseback are concerned, there may be some structuring. Sale may be at a more than market value or fair value. Lease may be at less than fair value. Okay, let us say original owner sells at more than fair value to the new owner, which means new owner will want more rentals in return, correct? Or owner says, I'll sell you at a discounted price. Then the new owner will say, okay, I'll charge you less rental. So such kind of adjustments might be there, and hence we need a specific treatment for sale and leaseback related transactions. Now, whenever there is a sale transaction that's happening, there can be a leaseback finance lease. There can be a leaseback of in terms of finance lease, or there can be a leaseback in terms of operating lease. And look at the way, if there is a finance leaseback, what happens? Owner first de-recognizes the asset, sells it to the buyer, and because it is a finance leaseback, the owner will again bring it into the books. So basically, from one balance sheet to another balance sheet, the asset has moved and again come back to the original balance sheet. So such kind of situations may arise, and hence we have a specific treatment for sale and leaseback related transactions. Okay. Now, if the sale and leaseback results in a finance lease, that is what I was telling you, right? The asset has gone out of the books and again has come back into the books because of finance leaseback. Okay. So, if there is any excess or deficiency of sale proceeds over the carrying amount, it should not be immediately recognized in the income or loss in the profit and account of the lessee. Meaning to say, you have given your asset, the same asset has come back. So, if there is any excess or deficiency, if there is any gain or loss over the carrying amount, then that should not be immediately recognized, but such gain should be deferred and amortized over the lease term, generally in proportion to the depreciation of the lease asset. So if there is a finance lease, you will not immediately recognize any gain or loss, and the simple reason being, my own asset I have sold and I have got it back as lease, asset lease back. I'm just moving the asset out and in the balance sheet. In effect, there is no movement of the asset. In substance, there is no movement of that asset, and hence any gain or loss will be deferred and amortized. That is when there is a finance lease. Then, if there is an operating lease, now in operating lease, the asset will not come back to the original owner. Under an operating lease, the asset will not come back to the original owner. In that case, we have to see what is the fair value, right? And based on the fair value, we have to decide what has to be done. Okay. So when this thing happens for operating lease, fair value have to be determined. So selling price may be equal to fair value. Selling price may be greater than fair value. Selling price may be less than fair value. This information will be given to you in the exam. Based on that, you have to decide what is to be done. Okay. Now, if the transaction is at fair value, then no need to worry, because it has happened as a part of the, as a part of fair value, as a normal transaction would have happened. So loss or gain recognized immediately. Loss or gain recognized immediately. Then the next aspect, if selling price is at excess of fair value, means selling price is greater than fair value, then is it that, are you making a real gain? Because the asset is again being leased back, which also means if you're selling at more than fair value, understand this logic. If I sell to you something at more than fair value, and if I again take it back on rent from you, then you would also charge a higher rent, right? Because you have bought it at a higher price, means you'll also want a higher rent. So this transaction may be a kind of a temporary financing kind of a transaction where you are providing additional money to the original seller, and hence in such case, if whatever is the portion in excess of the fair value, so think of this: selling price, fair value, carrying amount. Okay, selling price is 100, fair value is 80, and let's say carrying amount is 60. To the extent of difference between this fair value and carrying amount, whatever is the loss or gain, you can recognize. But this additional amount, 100 minus 80, that cannot be recognized as gain immediately. That has to be deferred. So if sale price is greater than fair value, the excess of sale proceeds over fair value should be deferred and amortized over the period for which the asset is expected to be used. So in this case, what will you do? Selling price minus fair value, this will be deferred and amortized. This will be deferred and amortized. Why will you defer and amortize? Because this is not the actual gain you have made. Actual gain is only fair value minus carrying amount. Now sometimes Carrying amount may be 90. Carrying amount may be 90. So you will recognize loss of 10. Then difference between this 100 and 80 will be deferred and amortized. Just because carrying amount is 90, you cannot say my, there is selling price of 100. So only I'll defer 10. No, you have to defer the entire 20. And for 10, you have to recognize a loss. Okay. Then if sale price is less than the fair value, if sale price is less than the fair value, then any profit or loss should be recognized immediately, generally. So if it is less than the fair value, you will recognize P&L immediately. But if the future lease payments are compensated, so if selling price is less than fair value, if future lease payments are lesser because of this transaction, then you will defer and amortize. So if the loss is compensated by future lease payments at below market price, then it should be deferred and amortized in proportion of the lease payments over the period for which the asset is expected to be used. So meaning to say, you can sell it at less than fair value. You can sell it at less than fair value. And because you are selling at less than fair value, and this difference is being compensated by future lease payments at below market price. So the thing is, I am selling you an asset at less than fair value. The lease back is from your side also at less than market price. The lease rent, because I am selling at a lesser price, I am saying, boss, because I have sold you at lesser price, you also charge me less rentals. So I'm compensating the future lease rentals. If that is what is happening, then you have to defer and amortize, right? So this is the crux where they're selling prices less than the fair value. Okay. Now this summarizes the overall part relating to sale and leaseback. And sometimes fair value is less than the carrying amount of the asset, then to that extent the loss will be recognized immediately. So here we saw, right, fair value is less than the carrying amount, then for this difference you will recognize the loss immediately. So you can look at this, these kind of examples before you, visit the examination on the day. You can look at these kind of examples, because if a question comes from sale and leaseback, I'm sure they will ask you 4 or 5 bits with different situations, and hence you will, try to understand what is to be done in each of these cases. Okay. So just to quickly run you through, fair value at the time of sale or leaseback is 1 lakh. Sale proceeds is also 1 lakh. So what is the carrying amount? 96. Is the transaction happening at fair value? Yes. So recognize the profit immediately. Okay. Then fair value is 1 lakh. Sale proceeds is 88,000. Sale proceeds is 88,000, less than the fair value. Okay. Now, is this being compensated in future? If yes, then you will defer. If no, then you will recognize immediately. There's no problem in that. Then fair value is 1 lakh. Sales proceed is 1,15,000. Now there is a gain. This 1 lakh minus 1,15,000. See, carrying amount is 1,20,000. Carrying amount is 1,20,000. That is just a second. So this amount is incorrectly put up here. Okay, so just excuse me for that. Okay, so fair value is 1 lakh. Carrying amount is 1,12,000. So 1 lakh versus 1,12,000. There is this difference of 12,000. So there is a loss of 12,000 to that extent. You will recognize that. And 1 minus 115, the difference between sale proceeds and fair value, this 15,000 profit will be deferred and amortized over the period of use. Okay, then fair value is 1 lakh, sales proceed is 1,15,000, carrying amount is 96,000. Now 96,000 to 1 lakh, anyways there is a profit that will be recognized immediately, and 15,000 of extra amount will be deferred and amortized, right? So just practice a couple of these kind of questions which are likely to be tested in the examination. So from this chapter, if I have to ask you, sale and leaseback, very important. Leases, accounting for leases in the books of lessee is important, and sometimes they test you on accounting, calculating the gross investment in lease, net investment in lease, and unearned finance income. That is one kind of question which is tested. Generally, these are the questions which are tested in the examination. Okay. So with this, we conclude AS 19. Okay, so no questions asked. I think we can call it a day for the session. Thanks for taking your time out and joining in. I hope these sessions are useful.